Welcome back, investors, to Ticker Time News. I'm Adam, and the SPY and the IWM, they both stalled at their 50-day moving averages today. The QQQ, not even there yet, but it could be there pretty soon. However, the DIA, which is the ticker symbol for the Dow Jones, it blew past its own 50-day moving average, with the Dow Jones being the first of the main indices to rally back above its 50-day moving average. This suggests that there is some interest in blue chip companies as the market shakingly rebuilds on this relief rally off the October lows, with the IWM, or the small caps, capturing a bid and punching through its 50-day simple moving average resistance today. But just briefly today, that would be seen as a very bullish as money flows more into what should I call small caps, a more risky asset group. But the IWM closed under its 50-day moving average today. So it is next in line. It is super close, just like the SPY. It is really close, but it did not break through that 50-day moving average like the SPY did intraday. Like the IWM did intraday. So if you're bullish on small caps or even the S&P, the SPY, or the SPX, we need to see those move past their 50-day moving averages and close above them, not stall out at them, not even get close to them like the Qs, but blow past them just like the Dow Jones did yesterday and then solidly today. That would be a very bullish view, which would put our next target for the SPX at least at 3,900. That would be 390 on the SPY. So those are the numbers, targets you're looking for. But first, they've got to break through the 50-day, just like the Dow Jones did, and then close above it. Now, since the S&P continues to capture bids onto that fresh October highs over 3820, which it did break today, that next target, like I just said, the early September low, which technically is at 3883. You can see we closed today at 3859, so not quite there yet. And to put it into perspective of where that 50-day moving average is for the S&P 500, that's 3868. So really, really close to that 50-day moving average, but not quite there yet. And then the September of 3883. But really, the only number you got to remember with me shouting out all these numbers is the 3,800 level for the S&P 500, or 390 for the SPY. We've got to break that. And if we do close above and hold above that 50-day moving average, that would put us in a very close proximity to that 3,900 level. Now, another thing to mention here, I mentioned yesterday that things were getting a bit extended, okay? Things are getting a bit extended now. But one more quick thought here on what we could see happening here. We are just a few days left until the month end for October. So we could see some bullish, let's call it window dressing. That could be in order as all the hedge funds and all the big investment firms out there try to show some solid returns for their clients. So we could see some foolery around with that. That could be in order. All right, let me get to some comments here. Almost Stock Lord, please bless us with your boundless wisdom. Let me throw this up here. Let me throw this on the screen so we can all see this wonderful comment. I'm on a losing spiral. Let's go over these earnings. Yeah, these earnings this week are key to how this market is going to move. We're going to talk about Enphase. We're going to talk about Microsoft. And we're going to talk about Alphabet here in just a few moments. So I do have those. But first, before I get to those earnings, let me just kind of put this in order and slow down a moment. I'm going to talk about tomorrow for just a moment. I'm going to talk about what to expect for tomorrow for the SPX, the SPY, the Qs, the IWM. I'm going to show you how risk is growing, okay? So I don't think this rally is going to continue too much further. And then we'll get into the day-to-day of what happened today. And, then we'll talk about the earnings for those three companies, then today, and we'll wrap it up with some of the economic data that is due out tomorrow. Housing market is just getting hit left and right with that. All right, so let's go ahead and swap those for this one. Losing spiral, we need to stop this. All right, let's do what we can to stop the losing spiral here, and let's go through this. All right, for tomorrow, like I said yesterday, and I'm basically just copying and pasting these couple of sentences. There's an opportunity here for bulls to really take control. We've seen the October low, and that was hit intraday here on the open of Thursday, the 13th of October. Since that bottom there, intraday, we've been climbing. All right. We had a bit of a flagging formation halfway through these green candles, but the past three sessions have been strong. Stopping at that 50-day moving average, though, is significant, okay? And that 50-day moving average happens to coincide with the upper end of the weekly expected move for the SPX and the SPY. Now, this rally, it could be a nice size rally for Q4 as market participants move forward and, like I said yesterday, climb the wall of worry, okay? Much like we did with the earlier in this year, I believe it was March when we had a rally, and it was the same thing. We were climbing a wall of worry back in March. The summer rally, that was front running a Fed pivot. We know the Fed's not going to pivot. It looks like the Fed may be slowing down, but not pivoting and not pausing. At least that's what it looks like right now. So there are, again, like I said yesterday, there's a lot of moving parts. We've got earnings, we've got the midterm elections, and we've got geopolitical concerns. That won't make this a straight line move to the upside like it's been the past three sessions. So the game plan, expect a more of a two-step forward, one step back, like I said yesterday, in price action. Although we are on our third step, we've taken our third step here with this rally so far, at least the past three sessions. So maybe it's a three-step forward, one step back. Who knows? But all joking aside, risk management and capital preservation remains critical. And speaking of risk management, here are the zones for the main indices for tomorrow to help us all manage that risk. Now, before I get to the earnings, let's go through SPX, SPY, Qs, IWM. So for tomorrow, this blue text right here, let me get my highlighter. We've got a high tomorrow, and this yellow box, this marks off the risk that we have in the market for tomorrow. The high for tomorrow for the SPX, and that's the S&P 500, 38.78. The low is all the way down here at 35.45. That puts us with a risk of 0.49% potential upside to a downside risk of 8.12%. And if you remember yesterday's number, risk is growing. That means this rally is getting ahead of itself a bit. Got that backwards. So, expecting this rally to slow down is what is being shown here for tomorrow's risk with the SPX. And you're going to see this trend among all of these main indices, okay? So that's tomorrow for the SPX. That 50-day moving average, again, at 38.68. That is a wall. As a matter of fact, conditions are ripe for the bears. In the short term, yes. In the short term, yes. But remember, and let me just go back to give an example of this, okay? When we were in, let's go back to the summer rally, and then I can go back to the March rally real quick just to showcase this. When you've gone through an extended period of a rally, let's take right here, these 3 sessions back in July, okay? RSI, for 2 of the 3 sessions, it went up. Then the RSI flattened out. We don't have a flattening RSI just yet, okay? Let's move this over so we can see better. This RSI right now, it's still inclining, okay? Back here, the RSI flattened out. That showed us that momentum was leaving, right? And if we go down to see the corresponding MACD, we did reach a peak right there. Hindsight, obviously. We didn't know that at the time, but we did reach a short-term peak. And that's what I'm looking for right now. I'm looking for a very short-term peak. Risk is growing to the downside, meaning what happened after this 3-session rally right here in the middle of July, the end of, what is that? Let me stop here. The end of July, going into the beginning of August. Then we move sideways. Because remember, in the market, we always have contraction leads to expansion, okay? Today, well, our most recent rally, we had contraction right here, right? We were moving sideways. We hardly went anywhere. Now we've been expanding for 3 sessions. Expansion leads to contraction, which then leads to expansion, which leads to contraction. It's like breathing, right? In and out. Expansion, contraction. Expanding, contracting. So that's what I'm looking for as the next part of this rally. We need this expansion to slow to a little contraction, whether that's moving sideways or what have it. Google's earnings, which we're going to talk about in just a moment, may impact the market tomorrow because they were kind of mixed, maybe not so great. But let's continue. All right, let's go back to March real quick and show you the same kind of thing that developed here. We had in March, going back to March the 15th, it was a Tuesday. We had 4 straight sessions of rallying. Big time. And again, if we look at that on the RSI was going straight up. Hindsight, it didn't flatten out until the following day. But then we had contraction where we moved sideways for about 3 to 4 sessions before expanding again and tapping resistance. So I'm looking for right now in the S&P 500, the SPX and the SPY specifically, I'm looking for a period of moving sideways because risk is growing. So in a bear market rally, you don't have to have, as the question here, and let me put it up on the screen right here. Conditions are ripe for the bears. Not necessarily, because what this is showing with risk expanding, with risk having a bigger percentage, right? Tomorrow, it's a 0.5% potential upside to an 8% potential downside. That's big risk. That's risk building. And when we were in our summer rally and our March rally, that didn't look like a U-turn and a big pullback. That just looked like we were moving sideways for 3 to 4 sessions. That's what I'm looking for right here. Now, I'm not always right, so don't take me as some crazy genius here. But we've gone through these 3 days of expanding, and what I'm looking for now that we hit that 50-day moving average and we're really close to that 3,900 area, is I'm looking for a place of contraction where we might move sideways for a few sessions. That's what I'm looking for, and that's what the upside potential to the downside potential is telling me. 0.5% potential upside move to an 8% potential downside move. That doesn't mean that we could potentially, well, I guess in theory, it does mean we could move down 8%, but that's not what I'm looking for. This has been a very strong rally. I'm using this risk to say, hold on, we may be pausing here for a moment and moving sideways. That's what I'm saying. So it may not be the best time to load up on shorts here. Now, if you are using a very strategic and tactical trading strategy, yes, you could slowly start to enter a short position because we've gone up. We've had a very nice rally. However, this rally, in my mind, could go up to this 4150 area, okay? Maybe a little bit less depending on the time frame of this rally. But this red trend line, and let me fix the chart here. I hope I'm making sense with this. But this red trend line right here, it started back in January, and it has captured all the major tops. The top here in March, it captured as resistance. It continues to move down, and it captured the summer rally top in August. And now that it's continuing to move down, right? When we get here to 4150, this rally, maybe it goes that high. Maybe it doesn't. The longer this rally takes to get to this trend line, the lower that number will be. Right now, that trend line matches up with 4150. But if it takes another month to get there, then we have to go another month forward in time, meaning this 4150 number would lower because that trend line would continue extending down and lowering the potential upside number. So I hope I'm making sense here, okay? Yes, I will get to the 15-minute, 5-minute. We'll look closer. I'm looking big term, big picture right now. Let's see here. All right. Let me pop this question in here so we can all see it. So you're saying that there isn't going to be a rally anytime soon? Not exactly. What I'm trying to say, and I'm hope I'm making this clear. We've been in a rally now for 3 sessions in a row, and it's been a very aggressive one. We were up 1.6% on the SPY, 2% on the Qs, 2.7% on the IWM, and the Dow Jones was up a percentage point today. Those are big gains, okay? So I'm not saying that this rally is over, but what I am saying is that now is the time for this rally to stall a little. Just like here for the summer rally, after we were rallying and then we stalled, we moved sideways for a little while. In the March rally, we rallied strong and then we stalled out for a little bit. That's all I'm saying, is that the growing risk to the downside is going to lead to a stall. There could be a potential pullback, a very small one, to this trend line. And now this chart is getting awfully choppy. But if we drew a trend line, and it's on the chart here, it's in blue, which stinks because everything else is in blue. from the October 13th intraday low, if we drew a trend line up, it captures that low and it captures the October 21st touch, okay? But that's only 2 touch points. And to make it valid, we need 3 touch points. We don't have that 3rd touch point yet. But we're getting kind of extended away from that trend line right now. So risk is growing. This isn't where you'd want to tomorrow open up a huge long position because the risk is growing. All right. Once this risk kind of flips sides and we have a bigger, and you could also look at this too as risk versus reward. What is the reward to my potential risk? A 0.5% reward to an 8% risk, that's not a very good risk reward setup. So you would not want to go long at this very moment in time because we're looking for this rally to stall. It tapped that 50-day moving average today, which that's a stall in and of itself, and it pulled back from that. Okay, let's clean this chart up here, and let's go look at, like you're saying here, shorter time periods. And then I'll move on to the SPY, the Q, and the IWM to point out basically the same thing, but the Qs, it's a little bit different. Just trying to get these blue marks off here right quick. Almost got them. Almost. Bear with me for a second. I should have kept it clean as I was moving along. Okay, almost got it there. There we go. Okay, let me go to a shorter time period. First, I'm going to start on the 15-minute. Okay? All right. Okay, so for the 15-minute time period here, you can see at the very end of today, that's where we almost got up to the 50-day moving average, and we almost got up and tagged the upper weekly expected move. All right, we almost did today. Let's open this up a little bit longer, a little bit more. I want to capture Friday through today, because that's the real rally that we're talking about right now. So we have Friday, we have Monday, and we have today, Tuesday. It's been a nice up and to the right move. Now, what I'm saying about this move here is the fact that we have gotten a little bit overextended here, okay? On the 15-minute time frame, this rally right now on the RSI is putting us at a 73. Now, that's different from on the daily view, okay? But on a short-term time frame like the 15-minute table here, it's a bit extended. And it just basically went up all afternoon. When we hit this lag here midday, okay, that's when the RSI had come back down, and on the shorter term, 15-minute time frame RSI, it kind of bottomed out here before then continuing its move higher. All right, let's go look at the 5-minute time frame. Let's see here. Pull this comment up here as we're moving. Also, almost everyone on CNBC can't stop saying Fed pivot or Fed Fed pause. There will be no Fed pivot in 2022. I am very confident there will be no Fed pause in 2022. Right now, and all we have are basically 2, maybe 3 data points. One is the Washington Post article that we went over during last Friday's live stream. That is a potential way to air what the Fed is thinking in a public way. Okay? So the Fed may be thinking of a potential slowdown in rate hikes. We also had a little bit of Fed speak last week saying the same thing, that maybe we should think about a smaller rate hike in December. Now, this week, there is no Fed speak and there will be no Fed speak. The Fed does not go out and talk the week prior to the FOMC meeting, okay? So we'll have no Fed speak, and that's why there's been no Fed speak this week, and we will have no Fed speak this week. So we won't have that in the markets. The only thing that the market is concerned about this week are earnings. All right, here's the 5-minute time frame. It's just today, right? Today we had a strong open this morning. We kind of petered out here about lunchtime, and that's kind of typical. Lunchtime on the East Coast, running until about 1 o'clock or so. There was actually a pullback before reaching this kind of low, before slowly accelerating into the close. And again, if we're looking on the 5-minute chart here, 5, 10, 15, about 20 to 25 minutes before the close, that's where the peak occurred. And then there was a bit of selling pressure into the close. Now, in the after hours, we have to talk about those earnings that I had mentioned before. But right now, I just want to talk about what's happening here. This, and you can see, let me go back on the, again, 5-minute. There's yesterday, okay? And there's Friday on the screen. And if we take this trend line here, let me put it on Friday for you, okay? Catching the bottoms, it looked like that. Now, let me take this trend line, all right? I'm going to move it over to Monday, and I'm going to put it on Monday's bottom. And what do you see? Monday's rally was not as strong as Friday's. Now, let's go and put that on today, and you can really see the slowdown. Okay, look at that. Today, that trend line doesn't even begin to match up at all. So that's showing me that as we have started on Friday, Monday, now Tuesday, this rally has been slowing down as we've been moving forward in time. Now that we've gotten to this point of a little bit of resistance here, and let's go back to the daily view. And let me take those blue marks off. I should have done that earlier. On the daily view, you can see that 50-period moving average is right there, right with the weekly expected move. They're all right there together, okay? And again, the 50-day moving average is at 38.68. So let's go back to that 5-minute chart here, 38.68. The high today was 38.61. 38.62 was today's high. So not quite there to the 38.68 there. Okay. That's going to be resistance. And it matches up almost perfectly with the weekly expected move. Not quite. The weekly expected move is 38.66. So 2 points. 2-point difference. All right. Let's go to, and I find it hilarious about mainstream media talking about the Fed pivot, Fed pause, and that's not what we're getting. All we're getting is a Fed slowdown. And once more market participants realize that, the more that this rally becomes risky. Now, here's the SPY. It's not that much different from the SPX. It's just a little bit of a little smaller volume, right? The money that flows through the SPY is not nearly as much as the SPX. All right, let me pull this up here out of the weeds so we can see this price action in the zones for tomorrow. Okay. Can you explain the indicators as well? If you're talking about the RSI and the MACD, the two on the bottom of this chart, if those are the two you're referring to, absolutely. Okay, for the SPY, it closed at 384.92. The upper end of the weekly expected move is 385. Absolutely, I can do that for you. 385. The 50-day moving average is 386. So 1 point difference between the 50-day moving average and the upper weekly expected move. Now, for tomorrow's zones, and again, they're highlighted by this yellow box here. So this can give you a visual perspective on what this risk looks like. All right. We have on the SPY a potential upside of 0.5%, a 0.5% to the upside versus 8.16% downside risk. This is showing risk is growing. Because remember, yesterday, the risk for the upside move was at 2% on the SPY. And it moved to the upside. How much? 1.6%. Today, that 2% upside has now dropped to only a 0.5% upside move for tomorrow compared to a potential 8.1% downside risk. So risk is growing. Yesterday, the downside risk was in the 7%. Today, for tomorrow, the downside risk for the SPY is in the 8%, 8.1. So risk is growing. And again, I'm not looking for this rally to just all of a sudden tuck tail and run all the way down 8% tomorrow. This rally has got some strength to it. But what I am expecting is let's go with Fed terms. I'm not expecting a price action pivot tomorrow. I'm not expecting a price action pause per se, but I am expecting a price action slowdown. How about that? And I guess I could potentially say a price action pause, because I'm looking for resistance right now on the SPY with downside risk growing. Okay? The upside risk, these zones right here and the potential, this is work that we've been doing behind the scenes. Okay? It's based on a formula just like the weekly expected moves, but slightly different. It still uses implied volatility from the options market in that formula, but the formula is a little more complicated. It's why we don't release it all the time. So we're kind of testing it here before we add it to our daily updates for our private investor community. So for the SPY, again, looking for a slowdown here. Risk is growing. Upside potential is shrinking. That risk reward to the upside is not looking so good at this particular moment. RSI right now is at a 58. It's not that high. It could go higher. 70 and above on the RSI, and that's the first indicator here at the bottom. This right here is the RSI, okay? The RSI gives you the relative strength index, all right? That's what this indicator right here is. The RSI, Relative Strength Index. It's giving us how strong of a move is this. And this is a little more of a special, it's not just a simple RSI, but it takes into account, and it's why you see the light blue numbers too. And why you see this, like the blue line kind of going like this, and the bottom blue line, you know, just kind of staying flat right here. These are the local tops and bottoms for the RSI. Typical RSI, you don't see that. Just a straight RSI. Okay, so relative strength. It's measuring the strength of the move. The MACD down here, that's measuring momentum, okay? The stronger the move up, the darker the blue or the green, however you color code it, the stronger that momentum is. The lighter blue, that means momentum is a little on the weak side. You see that on red days in an upward move. So that's what those two indicators are. All right. Let's see here. Okay. Let's go to the Qs. The Qs, it's going to look a little bit different. While the SPY, I could totally see a slowdown, a move sideways. The Qs may have a little bit more gas in the tank, because when we look here, now it doesn't show it when we're looking at the upside risk versus downside, upside and downside risk here. But on the Qs, we closed at 284. The upper end of the weekly expected move, 286. But the 50-day moving average, 289. So we've got a little bit more room here for the Qs to continue going. The RSI is at a 56. So it's barely over that midpoint when it comes to relative strength. I think the Qs, they could potentially keep moving. As long as the 10-year yield continues to come down, and as long as the dollar is either flat or comes down, then the Qs have a little bit more gas that they could go up a little bit more higher. And that's why you saw the SPY up 1.6% today, but the Q up 2% today. There's just a little bit more momentum that the Qs have that they can use. Now, when we're looking at the zones, the upper side of that zone is 286. All right. That's right where the weekly expected move is. The downside move here is 257. All right. Now, the upside is 0.8%. The downside risk is 9.2%. So while that downside risk does sound a little bit scary, there is a little bit more upside, just a little bit, potential reward still for the Qs over the SPY. If you get anything out of this, it is that the Qs, they could continue moving up a little bit more tomorrow. Well, tomorrow for the SPY, I'm looking for it to kind of fade out, slow down. All right, let's take these two lines off and let's go to the IWM. This is your small caps, okay? These are your small caps. Now, when you look here, the IWM, it did break above its 50-day moving average today, but then it pulled back and it closed below that 50-day moving average. Now, on the IWM, the high here for tomorrow is at 178. That's exactly where it closed at today. All right. Tomorrow, based off of these zones here, the SPY could stall, the Qs could go up a little bit more, but the IWM may just have a red day tomorrow. Why would that be? Small caps are more riskier assets than your, say, companies that are in the S&P 500, the SPY, or maybe even the NASDAQ. So those small caps, while they may be the quickest to rise, they are also the quickest to fall. And that's why you saw this 2.7% move in the IWM today. That was a big move. It did stall yesterday. That was a small candle yesterday. So let me get back to this. The lower end for the zone tomorrow is 165. Now, the upside potential tomorrow for the IWM is 0.17% to potential downside risk of 7%. So that's not a good risk-reward ratio if you're looking to go long at this moment in time. All right. So for tomorrow, if you're looking at the SPY, the Qs, the IWM, the Qs, I think, could have the bigger upside just based on the risk to reward. And since right now, risk is the top thing that we need to manage, that's why I would put any weight whatsoever in these zones here. Okay? All right. Do you think Apple moves SPY to 400 on Thursday? Let's put this up so everybody can see. Do you think Apple moves SPY to 400 on Thursday or opposite direction? Apple is a little bit of a tough one. The reason being is there's been reports, obviously, about Apple slowing down. I think Apple is slowing down, but Apple has got a core group of pure believers that buy the top-end Apple stuff every time there is top-end Apple stuff to buy. But I do think the FX, just like FX hurt Alphabet in their earnings today, FX or your currency is going to hurt Apple as well. So just a couple of risk points there for Apple. But it is a really good probability for Apple to do very well. Yeah, the best, yeah, I'm not even going to repeat it. Don't want to get in the wrong spot with the almighty algorithm from YouTube. So just ignore those bots there in the chat. Yeah, moving off of that. So Apple does have a good chance. However, Apple is a obviously huge mega cap. Apple's direction, whether it moves up or down, it does move the market with it. But SPY to 400 on Thursday, absolutely not. I can be firm about that one. The SPY to 400 on Thursday, nope, no way. I do not see that happening. It's really hard to, because we've got the 50-day, that's resistance right there. That's at 386 right now. We've got the upper end of the weekly expected move. That's 385. I know we're just pennies away from that right now, but the downside risk is growing on this rally that we've been in. So getting up to 400, that would be tough, especially when just above where we are right now, just going back just a little bit, that 390 zone, okay, which is right here, right here, right here, 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 and here. 390, if we break above that 50-day moving average, 390 is going to be a tough one. Breaking above 390 is going to take more than just Apple to move it above that. Now, if we break 390, then 400 is easy peasy. So keep that in mind. 390 is the line in the sand for the SPY, okay? Even looking at the volume shelf profile, 390 is one of the biggest price points on here. As a matter of fact, if I can see I can't quite see it. Gosh darn trend line in the way. Okay. Let me move it down just a little bit so I can see, and then I'll put it back up. What are we looking at? That's at 315. Okay. So at that $390 a share price point, we're looking at 16 million bids and 17.7 million on the sell side, okay? Giving us 33.85 million total trades taking place at 390. So that is a very, very important number on the SPY. All right. So let me, I got to move that trend line back up. Don't want to forget about that. And that's at 415. Came in right about there. All right. Okay. Let's see here. Let's go with the next one up here, and I'll get into ENPH in just a moment. That's the next company I want to talk about their earnings. I hope the seasonality charts pay off. Got stopped out of short positions, and my long buy order triggered after hours. Not a huge position, but I want to load up for the Santa Claus rally. Yeah, let me just go ahead and pull that up here for anyone who doesn't know. This is the S&P 500 midterm election year seasonality pattern since 1946. So the red line is the line that we're tracing. We've been tracing it all year. It's not exactly precise date to date matchup, but it is so spot on. Just in case anyone new here, we've got the June low. Bam, we got it. We have the September low. Bam, got it. We have the October low. Bam, got it. Now, the tricky part here is that once we reach that new low for October, there should have been another low that undercut it. Now, we could look at the chart and we could theoretically say that the intraday move down to almost the 340, what was the low here? 348. This intraday move, this big green candle that took the SPY to 348, that did undercut the new October low for 2022 that took place just the day before. So this could be that undercut that we see on the seasonality chart, right? It doesn't say whether this has to be a closing low to undercut that October low, so we could have it. So if that's the case, the rally that we're in now could take us up to just after the midterm elections, right? So if we're looking at that, this rally that we're in right now, this could take us up to the next FOMC meeting, November the 2nd. That's when the next rate hike will come out. And that's when we'll get the next read on what the Fed is thinking. So maybe that's the route we're following with this rally that we're in right now. And then afterwards, it calls for a pullback, a pretty substantial one, a very choppy one. And we could get that in November, because what if on November the 2nd, the Fed comes out, they do a 75 basis point rate hike or a 100 basis point rate hike, but then they're unsure about what they're going to do as far as the December rate hike. That's going to leave the market to its own devices, chopping around, chewing up capital, not knowing where to go or what to think. And that could be what leads to the November sell-off. Then we get the Fed coming out. They do a softer 50 basis point rate hike in December, and we get the year-end rally. That's what I'm kind of thinking and trying to play through here as what could this seasonality chart be telling us, since it's been so spot on this year, right? So just some thoughts there about this. All right, let me clean up a couple of these blue marks here, and we'll keep moving. I do want to get to end phase. Can you check on Intel? Ton of bullish bets. Just playing TQQQ. Yes, I'm playing TQQQ as well, which is going long. As a matter of fact, let me go ahead and go over here, TQQQ, pull that up for you just to show you. This is an not inverse, a leveraged for the QQQ. So as the Qs go up, these go up too. So with the Q going up, let's just load here real quick. Almost got it, the data. All right, so while the Q was up 2% today, this was up 6% today. So that's how it works. 246, 3x. It's just like buying an ETF. You can do options on it just like you could an ETF. Works the same way. So this is, if you're bullish on the Qs, this is where you would go for that trade. Let me check in on Intel real quick, and then we'll get going to end phase. INTC for Intel. Semiconductors, just to give you a kind of a historical stance on this, semiconductors typically perform well in the fourth quarter. So semis do have that going for them. Semis have had it rough in 2022. I mean, look at Intel. But it too has made a turnaround here. Let me adjust this chart right quick. Has made a turnaround here, but it is going into earnings. Earnings could be a little rough for Intel. One, because of the strong dollar. Two, because of the restrictions that were placed on semis, on chips, more precisely, by the United States. So you've got those things to contend with Intel's earnings, but they have been moving here in the right direction, just like the Qs have been in this rally. Let me pull this up out of the weeds here. So yeah, on a daily view, this is looking pretty nice, but let me get it stable here and open up a little. You can see though, this rally that we've been in, you can see that each day it's just slowing down a little bit more, a little bit more, a little bit more. Now it is getting to a point, and if we look at the volume shelf profile on the left hand side, we're getting to an air gap here. So once we get to the upper ends of $27 a share, we've got an air gap right here where it just kind of dips down until the $29.50 a share. So if we were to break out of the $27 a share, like 27.8 dollars a share, it should be a pretty easy ride up to $29.50 a share. Not perfect there, but that's what I'm seeing here. And that also coincides with its 50-day moving average, which right now is at 29.39. So let me just say that again. Let me put a trend line right here at about 27.88 a share, $27.88 a share. You break this and it looks like you'll have a clean ride to $29.50 a share, which is right about where this 50-day moving average is right here. All right, let me just change that to red. That's resistance. So just on a short term here, that's what we're looking at for Intel, just technical wise. Now, if we look at the RSI, it is a bit above its local high that it's been making for a couple weeks here, but it's only at a 54. So it's really just halfway, right? Momentum is building. It could go further. So again, watch that 27.8. It breaks out of that, and you've got an easy ride to 29.50 for Intel. I hope that helps. I hope that helps a lot. All right, let's go to ENPH. ENPH. And of course, if you have questions, plug them in. I'd be happy to go over them anytime. We don't have to wait till the end to go over any of your questions. All right, let's keep rolling. So with ENPH here, ENPH had a bit of a volatile, excuse me, aftermarket or post-market. It was up 4.85% on the day. Yeah, just looking at this thing, yeah, it punched above that. It punched right above that 20-day moving average today. That's good. Real nice move. Real nice move. Okay, so their earnings. They did beat expectations for their Q3 earnings and revenues, or EPS and revenues. And they also guided their Q4 revenues above expectations. Those were all good things. ENPH also said that their quarterly revenues hit a company record, which was tremendous. It was like 635 or so million. It was up 20% quarter over quarter and up 80% year over year. So that was really, really good. And its Q3 GAAP gross margin rose to 42.2%. and that was up from 41.3% in Q1 and 39.9% a year ago. So even an improvement there on its margin. Now, the company also said that Q3 revenues in Europe, they jumped about 70% from last quarter. Almost 70%. That is just awesome for ENPH. And they said that the reason it occurred in Europe is because the region is accelerating their efforts to address the rising cost of energy. And of course, their reliance on fossil fuels. So that was really good for ENPH. ENPH also issued upside guidance for Q4, forecasting revenues to be somewhere around the 680 to 720 million versus the expectation of about 663 million, which is real close to what they hit this quarter, maybe just a little bit under. Now, with their GAAP gross margin, they're expecting anywhere between 39 and 42%. Adjusted gross margin, somewhere between 40 and 43%. And then if you look at ENPH's stock price on the year, so let me get all of 2022 for the chart on the screen here. This thing has just been a beast performing. And it's a little bit in the weeds there. I could fix that. Let me just do that. There we go. Gotta tighten it up just a little bit more now. Okay, so look, ENPH, it's in the green for 2022. The stock is up over 40% year to date. It is has been a real nice performer, especially in the first half of the year. It reached its peak over this past quarter. Can it get back to that peak? Sure, it could. We also have to see how macro conditions play out. But with this earnings report and with ENPH guiding above expectations, ENPH is a good, solid company. They are a bit expensive. I will have to say that about ENPH. Even though they've done so well this year, stock price wise, and the company has just done really good this year, it's a pricey $35.9 billion market cap for ENPH, but if you get past the priciness of it, maybe any pullbacks, sure. It's a solid company. I like ENPH for sure. They've done a fantastic job this year. So there's just some quick news about ENPH and their earnings. Now let's go to Microsoft. And again, we'll just be quick about this. MSFT is the ticker for Microsoft. Microsoft shares, they did dip a little bit in the after hours. Unfortunately, it's too late. I can't see what the after hour movement is. But they've been running nice too since that October low, up another 1.38% today. But shares did dip a little bit in the after hours when I was looking at it. And I'm not quite too sure why just yet. And as I'm looking here at the stock chart, I got to pull this trend line across. It was an important one here that stopped it on Friday to a T, and then it gapped up on Monday, and it's at its 50-day moving average as well, which is at 251. It's at 250 right now. It's just pennies off of it. That could be seen as some resistance here for the stock. But anyways, moving on to a couple notes from their after hours. Microsoft, its cloud business really did good. And for our private investor community, we sent out a Microsoft earnings preview. And this is one of the things that we talked about that could be a net positive for Microsoft. Their cloud business, it just did wonderful. It reported its fiscal first quarter results that surpassed expectations. Microsoft said that it earned for EPS $2.35 a share on $50.1 billion in revenue. Revenue from the intelligent cloud computing, including Microsoft's Azure and other cloud services, was the biggest piece of the company's revenue. It totaled about 20.3 billion there, up 20%, up 20% for the year. I'm sorry, from a year ago. Let me just get my notes here. Getting a little blurry here on my own handwriting. Up 20% from a year ago. Now, Microsoft, they do not provide forecasts until their earnings call, so I didn't have that information to go by. And that's all I wrote down for Microsoft, is just that their cloud business was awesome, and it did really good. There were some other troubles, though. Advertising was a soft one. Same thing with Alphabet, which is what I'll be talking about next. All right, so let's just keep moving on. Let me go to Alphabet. I know not a whole lot there about Microsoft. I do see this 50-day moving average acting as some resistance for Microsoft. Again, it's at 251. Microsoft is at 250. Let's go to Google, or Alphabet, I should say. GOOG or GOOGL, either one for Alphabet. Now, Alphabet's stock did fall over 5% in the after hours for its Q3 results. They missed expectations on top and bottom lines. So EPS and revenue missed it. The company joined other tech companies like Snap. I'm sorry, not Snap. Microsoft. Oh, this was another negative for Microsoft too. Currency. A strong dollar hurt Alphabet. A strong dollar hurt Microsoft. And it's all because multinational companies, when they sell a service or product in another currency, and then the dollar is strong, and they go to exchange that currency back to dollars, they're actually losing money. So a strong dollar will actually hurt them. For Alphabet, revenues grew 6% to about $69 billion, short of the expectation of $70.7 billion, or 8.5% year-over-year growth. However, if we did not have a strong dollar, that revenue would have grown 11%. Think about that for a moment. If the dollar was weak and not strong like this, Alphabet would have grown its revenues 11%. That would have beat expectations, and that would have pulled in way more than their 6% from today's announcement. So that is just pure proof how a strong dollar hurts multinational companies. Now, Google Cloud, it was $6.9 billion. It was up 37.6%, and was the top segment at Alphabet, while YouTube ads, which brought in about $7 billion, was down 1.9% and was the bottom segment for Alphabet. So that makes sense Google Cloud, any cloud offering is a strong grower right now, and it will be for the foreseeable future. YouTube ads, that's just like if you go to any ad, online ad source, Snap is another company, Meta Platforms, they're going to be hurt because advertisers, just like YouTube ads getting hurt, advertisers are pulling their funding for digital ads as the economy is slowing down. So this is just more proof that the economy is slowing down when you look at YouTube ads being down 1.9% and being the worst performing sector for Alphabet. Okay. Let's go with your questions instead of any other of my notes. That was it that I wrote down for Alphabet. It was just real quick. Let's see. How about Bank of America, JP Morgan, financial sector? Okay. So let me just pull up financials. XLF is the ticker symbol for the financial sector. And the one thing that I would say to be clear about on financial sector and your big banks like Bank of America, JP Morgan, is we are going into a period of slowdown, right, for the economy. What's that mean for banks? What's that mean for the financial sector? That means smaller margins. That means less loans will be lent. Now, you could say, well, there's a higher interest rate they're going to get. Sure, but that's not going to offset the volume of loans lost. Second point, banks do not do well when we have an inverted yield curve. The 2-year and 10-year, that yield curve is inverted. Right now, the 2-year costs more than the 10-year. Banks borrow short-term, they lend long-term. So that means banks are borrowing money at a higher rate than they can lend that money. That hurts margins. So this is not a super great environment for banks. Now, why has the financial sector been looking pretty strong? That's because the 2-year has kind of peaked, right? That's why let's pull this chart up out of the weeds here and open it up some. That's why the financial sector just completely blew past its 50-day moving average today. And that's all because the 2-year came down. There was an auction for 2-year treasuries. Okay. It didn't do so good. It didn't do so good today. So with the 2-year interest rate coming down, that helped the financial sector to explode past its 50-day moving average, which acted as resistance just yesterday. So a couple of things there about them. Let me go to Bank of America here for you. BAC, or Bank of America. And we'll just look here real quick at the charts, and I'll look at JP Morgan. While it's loading, there we go. All right. The last earnings of delinquents that they reported or defaults that they reported, they had a bunch of capital. They said the consumer was strong. Do I believe that? No, I don't. Let me try and get this trend this earnings marker on here. There we go. I do not think the consumer is strong. There are too many other signs that shows consumers going into debt. Maybe that's a good thing for banks. Actually, now that I'm thinking about it and saying it out loud, but it's not for the consumer. And if we're going into an economic slowdown where the Fed is raising rates, the Fed is already anticipating that the employment rate is going to go up. That means people are going to get fired. Companies announce every day a freeze to hiring or layoffs. They haven't been big. They haven't been big numbers yet, but those big numbers will come as this economy continues to slow down. When this economy slows down, this is not going to be good for banks. This is not the time, I think, really, to go long on the big banks. Now, when that yield curve uninverts, I think that is a better time to go longer on banks. Depending about other macroeconomic conditions, I think that would be a clear sign to say, okay, now let's start taking a look at some of the banks, right? That hasn't occurred yet. So I haven't been looking at banks, just been paying attention to the financial sector as a whole, but not really banks. Let me look here for Bank of America. How has it performed this year? Down 21.5% year to date. Not great. It is up 10.8% over the past month, so it's had a nice bounce from that October low. If we look here on the right-hand side of your screen, what we're looking at right here is Q3 21 through Q3 22. And what you notice is this purple line, which is its profit margin, is going down. Okay? And going down. So over the past 1, 2, 3, 4, 5 quarters, that profit margin has been going down. It will continue to go down. Margins will continue to be compressed. That's not good for a bank's or any equity stock. Plain and simple. If margins are going down, that's not what you want to see. Just bird's eye view numbers. You want to see that margin going up, or at the very least, holding flat. Okay. Revenue did go up over Q3 22, where it had kind of been stagnant over the past 4 quarters before that. That is one plus sign. Looking here at its net income had been going down for 4 quarters, but last quarter it did tick up just a little bit. That is a positive, but that could all be due to revenues increasing. Okay. But that profit margin, they've got to get a hold on that. And unfortunately, with the slowing economy, it's not going to happen anytime soon. All right. JP Morgan Chase. Let's pull that up real quick. And then we'll talk about a couple things real quick. I don't want to keep you here for too long. I'm going to keep this real short. Basically, the exact same thing that I said about Bank of America. You can copy and paste it right over to JP Morgan Chase. As we go down the line here, let's go look at their profit margin. Almost something similar. All right. Q3 21 to Q1 22, that profit margin dropped, It's still been dropping, but not nearly as quickly. So it's almost flat, but still down just a little bit. Now, with earnings and with this rise in the stock price, you see my two blue lines there? That's showing you that since June, this stock has been trading sideways. It's gone nowhere. Now, if you're trading, okay, and you bought it at the October low and you're going to sell it, now may be a good time to think about that. Because let me take this top blue line off so you can see the price action a little bit better. But it basically stalled today. It stalled yesterday. It stalled today. Both days did not break this high right here that was set on August the 16th. If it can't break that high, then it's likely to not go anywhere. So this is a very important high that it needs to break. That closing high was 123.63. 123.63. It's at 122.7 right now. All right. It needs to break that closing high right there, again, August 16th, for this thing to go anywhere. The problem is, look at the volume shelf profile over here, and you can see that right around that price point, that's it. That's it. Demand dries up and disappears. But if you could catch a bid that broke that high right there, if you can catch a bid that broke the August 16th high of 123.63, then you could take this thing up to 129, 130. Because there's a big gap in demand between those two price points. So just technically here on a chart, that's what it needs to break, and that's where it could be going. Now, the only problem with that price movement is the 200-day moving average is likely to be a barrier. Because if we go back and look, let me fix this chart right here. If we go back and look, let's go back a little bit here. Let's look at that 200-day moving average. Since the peak that occurred October of 2021, since that peak, the 200-day moving average turned over and has been heading down. That is going to be a significant resistance point for JP Morgan Chase. Now, to give you a number, that's at 126.3 today. 126.3 today. So that's important. All right, I'll go to, let's go to another one here on the chart for you. Let's see here. We got GD. I've got to talk about this in correlation to with one other thing, and it's going to open you up to understand gold a little bit better if you don't already know it. With gold, as soon as this chart loads, oh, why did I think it was gold? This is General Dynamics. My apologies. My apologies. Completely different company. Defense companies, we're in more right now. Okay. Defense companies are going to be high demand, no matter what. Doesn't matter. As long as there is a war somewhere, right, ongoing, you can count on defense companies to continue to appreciate. Now, the one thing that I would point out here is that if we look going back right here, okay, catching the bottom here, catching that bottom, all right, if we put a line up here, that's going to be a nasty sticking point that just shows that it's been trading sideways going back to March of 2022. That's a long time. So if you're trading this as it's approaching that, which is real close to earnings are tomorrow, as it's approaching that, depending on what earnings say, this could be an instance of sell the news. This could have been from the September bottom to the October bottom to today, a buy the rumor for a sell the news after earnings. So be careful about that, okay? But generally speaking, as long as there's a war, defense-oriented aerospace defense, you know, they're in need. In the government, if the U.S. gets more involved, then, you know, they could just shoot up. They could just go on and on. And, you know, that's why March was such a significant high, because of the Ukraine war, right? And Russia invading it. All right. Who else did you have here? LMT. Lockheed Martin. Same thing. Same thing. We could have a bit of a... the reason General Dynamics was up so much was most likely due to Lockheed Martin's earnings right here. So this move right here in Lockheed Martin, General Dynamics, again, buy the rumor. They were buying the rumor that another defense-oriented company had a earnings that lifted them off. They probably, their stock at least, people were buying them thinking, well, if we get a good earnings report, we can sell the news. So be careful tomorrow with General Dynamics. I'm afraid that there could be a bit of buy the rumor, sell the news because of Lockheed Martin. But again, if you look at Lockheed Martin, beginning of the year, March, and so it reached a high. Yeah, that's going to be a sticking point here for Lockheed Martin to try to break that high, right? That's going to be a sticking point. And if I go back any further, there's really, because those were significant highs right here, there's not a lot of volume. So not a lot of demand up there for buying once you get above those highs. And that's the problem when you are making, you know, let's just call it 52-week highs up here. That's a problem. You typically don't know what the demand is going to be and how far it could go. But there was definitely demand down here at the bottom for Lockheed Martin. How about short sell on these? I don't know what the short sell numbers are for these companies. I don't have access to that information right now. So I don't have a clue what short interest could be on these companies at this moment. It's something that I can research, but I do not have that information. All right. Let me clean this chart up here. Wrong button. There we go. All right. Let's see. Let's go to the dollar here right quick, because the dollar and the 10-year, they've been the driving story. So today being up like it was, as the dollar loads, and I can zoom in here, you're going to see something significant here forming. Ignore the zones here. This was for today. And I don't have the updated numbers here for tomorrow. So ignore those. Oh, you are absolutely welcome. Anytime at all. All right, so yesterday, and this is the perfect example of the zones and how they work right here. Yesterday, we had a 2% potential upside to a 0.9% downside, right? What did the dollar end up doing? The dollar ended up going down 0.9%, exactly where this downside move had the potential to go. That's what the dollar did. Now, interestingly, I don't know that the dollar is going to go down tomorrow, okay? I know, without having the updated numbers here on the screen, that the percentage point for the upside has gone up for the dollar, while the percentage point for the downside has dropped for the dollar. So the risk reward is in your favor tomorrow of the dollar going up. And that is something that can cause the SPY, the SPX, the Qs, the IWM to stall tomorrow. Okay. If the 10-year also goes up with the dollar tomorrow, that could stall the Qs. But if the dollar is rising, but the 10-year is not, that could allow room for the Qs to go up tomorrow while everything else stalls. Why do I think the dollar is going to be green tomorrow? Simply because of this 50-day moving average, okay? Let's just go back here and look. For 2022, all right, for 2022, let's do this. We start out in January. Let's get that exact January the 3rd. On January 3rd, the dollar bounces off of its 50-day, okay? Then it kind of dives under its 50-day, and that's because the year is really just getting started. But starting in February, all right, so the month of January was kind of but starting in February, the dollar bounced off its 50. The next time the dollar bounced off its 50 was right here. This was in June. The next time was right here, okay? That was in August. And people were already calling a top for the dollar for that July high. That was not the top for the dollar. But the dollar did go under its 50-day moving average for 3 sessions right here in August. Right here in September, it bounced off its 50-day. Today, it closed pretty much on its 50-day moving average. So knowing what has happened thus far in 2022, what would you place the probability at of the dollar bouncing off its 50-day moving average tomorrow? Would you give it a high probability or a low probability? Let me know. I would give it a high probability that it will bounce off its 50-day moving average tomorrow. If the dollar goes up tomorrow, the S&P 500 will not. And to show this, what I'm going to do is I'm going to put the SPY on here. Look, it's right there because I've done it so many times. As the dollar has been going up this year, what has the SPY been doing? Going down. And whenever the dollar goes down, what does the SPY do? It goes up. Look at this, just the most recent. Okay, the October 12th low. The dollar has been going down. The SPY has been going up. All right. Prior to that, we had, the dollar rising and the SPY collapsing. Before that, the dollar was coming down. And what did the SPY do? It had a little bounce before coming back down, and then it had its real bounce, right? So just to say that if the dollar does go up tomorrow, that's not looking good for the SPY. The SPY is at its 50-day moving average right now. That's going to be resistance. The dollar is at its 50-day moving average, and that will be support. It's pretty simple. Don't want to overcomplicate anything, but this is a very simple and easy way to look at how things could be responding. And like I mentioned earlier, when I thought I was about to look at gold, because I totally misread the ticker symbol, gold also has been in 2022 moving in the opposite direction of the dollar. So when the dollar cools off, the gold, it does not. The gold rallies. All right, let's see here. Let's do this. All right. I know I totally didn't really go over any of my notes per se about today. That's because so many of your questions were being asked today, and that's the whole point of this live stream, is to answer your questions. So we've been here an hour and a half, and I haven't really even touched my notes, except for the few notes about the earnings from ENPH and Microsoft and Alphabet. So do pardon me if you were here because you wanted my notes about today, but of course we didn't get to them because of your questions, and that's fine, because I absolutely love your questions, and that's why we're here. So I'll wrap this up with talking about what should be on your mind for tomorrow, as far as economic data, also earnings reports. There's a whole bunch of them that come out tomorrow, including tomorrow morning after hours. Tomorrow morning we've got automatic data. ADP is the ticker symbol. We've got Boeing, General Dynamics, like we looked at earlier, Harley-Davidson, Hilton, Kraft Heinz, Norfolk Southern, Seagate Tech, Waste Management, a whole slew, can't name them all headlining earnings reports. And then, of course, market participants, be on the lookout for economic data tomorrow. That includes at 7 a.m., we get our weekly MBA mortgage application index. It's been dropping week after week after week. It was down 4.5% last week. Don't expect anything different from that. 8:30 a.m. Eastern, we get the September advanced goods trade deficit. The prior reading was a negative 87.3 billion. We get the September advanced retail inventories. Prior reading was 1.4%. And the September advanced wholesale inventories. Prior reading was 1.3%. Then at 10 a.m. Eastern, we get the September new home sales. Expectation is 575,000 units. The prior reading was 685,000 units. All right. So that's it. That's all you got to be on the lookout for tomorrow. Be careful tomorrow with the SPX and the SPY. Risk is growing. Qs may have the best opportunity for tomorrow. As far as a risk reward goes, IWM, it wouldn't surprise me if it had a pullback or went nowhere tomorrow. The dollar, it's on that 50-day moving average. It is most likely going to bounce off of that 50-day moving average. I would be very surprised if it did not. So keep an eye on that as well, because if that dollar does bounce, that could definitely play a role in why the SPY will pause, the IWM will reverse and have a red day. If the dollar and the 10-year both go up, then I would expect the Qs to have a more difficult day at it. Now, before I wrap up this live stream, can you please do me a favor? Click that like button and share this video with a friend. Those two things help out this channel tremendously, and I greatly appreciate them. If you would like to join our private investor community to get instant access to our weekly momentum video, weekly momentum stocks, they come out later this evening after this live stream. And yes, there is a new leader after 3 weeks of ExxonMobil being the #1 top spot. We have a new top spot for the top 10 momentum stocks list. A new leader for this week. That you'll be interesting to see who that is. Also, get access to our weekly expected moves, our numerous trade setups, top 10 stocks, value, growth, dividend, and of course, insights on economic data, numerous market insight. My brain is like overloaded right now. That's it. That's all I got to say. So if you want more, if you like this perspective, click the first link in the description. If you want to join our private investor community, click the first link in the description. We'd love to see you there. We think the value is spot on. So yeah, that's everything. I want to thank you for being with me today. I greatly, greatly appreciate your questions. We'll be back here tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. And of course, the most important thing, I greatly appreciate each and every one of you. Your question is why we do it. So I'll see you in the next video. Take care.